Good morning, everyone. My name is Don Daniel, founder of P.I.L.L Method International, a better way to eliminate debt. Today, we're going to start digging down deep into where all of this came from. And in 1936, we got the first, all right, let me see. I got, hold on for a second here. I have something, I got something going on here. Right. Let me, there we go. I think I've got it. I had an echo. So now I got it fixed. Okay. I had an echo. I got it fixed. So in 1936 was the first self-amortizing mortgage. And it was in response to the Great Depression. All right. In 1929, the stock market crashed, and listen, it wreaked financial havoc on the United States. And I mean, it was terrible. And as a response to try to pull the US out of that, one of the things that FDR, Franklin Delano Roosevelt, did was, institute what they called the New Deal. And part of that New Deal was to take some of those mortgages where people had defaulted on. And when they defaulted, he says, okay, let the government is going to buy them back, all right, and then reissue them as 20-year mortgages. And I'm going to get into why they did that and why that was necessary. So I even got a link to an article that you'll be able to read that we're going to be referencing throughout today's show. But if you want to talk about this, you definitely want to come on stage. All right. And I'm going to put the link for the show on in the chat so that you can come live if you want to on YouTube. But I just want to let you know that no education on how loans actually work has ever been part of financial literacy in the United States at all. We're expected to use these loans, but we have not been taught how to use them. And I'm telling you today, what you're going to find out is actually shocking how much we don't know about how loans actually work. So if you want to know today where it all came from, if you want to know why we're in the shape we're in and understanding how loans work, if you think that mortgages were put in place to actually help the consumer, what I'm going to tell you today is mortgages were not put in place to help the consumer. Mortgages were put in place to help banks. But I'm going to show you what banks don't want you to know so that you can turn the tables today. You can start to understand what's really going on and use the amortization schedule that the banks have used to make so much money since 1936. You can turn it around so that you can pay off all of your debt. I mean, your mortgages, your student loans, credit cards, car loans can all be paid off in about 7 to 9 years. So if you want to know more about that today, let's get ready so you can find out more about the 1936 financial deception. Let's go, everybody. All right. Here we go. Listen, it's going to be a great day today. All right. I'm excited about this whole show. If you want to know more about what's going on and you want to talk about it, please feel free to come on stage. Let's talk about it today. We're actually going to get into some things that you need to also know about. Okay. And let me see. I gotta get everything together here so that you can actually see what's going on my screen so we can put that up. Now, before we get together, before we start, I want to show you what can happen if you want it to happen. What can happen if you want it to happen. If you want to see my screen, all right, let me get the YouTube link. All right, we're going to copy the link. We're going to put it here in Clubhouse. Okay. And if we all right, let me see here. There we go. Here is the link. All right. That's so you can see the screen. Okay. So if you want to go on a separate device, you'll be able to see it. And good morning to everyone here that's watching us live on YouTube, Facebook, and LinkedIn. Okay. So I want you to also, all right, be able to, let me see here. Let me go to the comment section. All right. And I'm going to place an invitation to you all. All right. Let me put the invitation in here so that if you want to, you can come on live on the show. All right. We'll paste that. That's going to be in um, you're going to be coming into StreamYard so that we can talk live if you want to talk live. All right. But first of all, I want to show you something that once you understand this, I don't care what the interest rate is. You can manipulate the interest rate so that you can profit. You can benefit as a home buyer. You can benefit as a person who is a real estate investor. Okay. So first of all, let me put this on the screen. I'm going to add this. Okay. And let's see here. We're going to add that. We're going to use this one here. Okay, good. So we're going to add this. Now, here is $188,900 mortgage. Here is $73,000 in credit card debt. 73,000. Now, I didn't say 7,300. $73,000 in credit card debt. Okay, averaging 23%. Once you understand how all of this works, I want you to see that instead of the $349,900 the bank wants them to pay in interest, they can pay $97,000 instead. That's a $252,000 interest savings. That's 72% off, folks. 72% off of what the bank wants you to pay. And you can do that with your current budget, all because we have not been taught since 1936 how this thing works. The very first 20-year mortgage was in 1936. Well, the 30-year mortgage didn't show up until I think in the 1940s. All right, we're going to be able to go over that today. Okay, so let me see here. Let's bring whoever wants to come up. All right, so whoever wants to come up can come up. And let's see here. All right, Ken's Lending Network. How are you doing?
Good morning, Darren. Good morning.
How's everything, man?
I'm blessed. I won't complain.
All right.
I can't complain.
So listen, you gonna be around for a while?
Yes, sir.
All right, listen, I'm gonna make you a moderator then so you can help me bring other people up because I've got several screens I'm going to be watching. Hey, Dornico, I haven't seen you in a while, man. So let's go ahead and get that done. I'm going to attempt to bring Chatter online this morning. How about that? So we're going to do that this morning. Let me fix this up. And let me see here. There we go. Bring Chatter online. See if we can do that. All right. So the folks on Chatter can benefit. All right. We're going to get that together.
I'm about to drop a couple invites for Chatter too.
Oh, you're going to do that too? Okay.
Yes, sir. They'll be in the chat if anybody want them.
All right. All right. So let's get that done. And let's see. We're going to pull this up.
Because y'all, man, Don do a brilliant presentation. Listening to it is educational, but looking at it, how you break it down, it's a must. So if you're not following him on YouTube, or if you're not going over to Chatter to see it live, man, you missing out. Don't cheat yourself.
Okay. Okay. All right. Let's see if we get our let me see if I've got everything together there on Chatter. And it looks like we are good to go. Let me see here. Get this going here. Cancel that. All right, folks. I think you're going to like what you see here today. All right. And all right, we're all connected. We're all connected. Okay. So I'm going to be watching the Chatter. All right. So, folks, if you want to see what's going on today, all right. So I'm going to also put the link to our live here on YouTube. I'm going to put that in Chatter as well, so that if you want to, you'll be able to see what's going on. Okay. So let's put that in the chat. Okay. There we go. If you want to see what's going on. And let's see here. Okay, good. All right. So listen, folks, here's what I want you to see. Here's what I want you to see. The interest rate on this loan is 5.99% or 6% on the mortgage. Okay. And the way that we're going to take a look at $262,000 in debt, here is what we were never supposed to know. Long-term debt, 30-year debt, was not supposed to take 30 years to pay off. If you know what to do, you can pay it off in 7.7 years, because you are not required to pay all of that interest. You're not. And we were never told that since 1936. Okay? So that would mean your effective interest rate would be on these loans 2.23%. In other words, if you were to borrow from the bank $262,000, if you were supposed to borrow $262,000, some of which was at 23%, the mortgage was at 6%, you can treat all of it as if it were 2.23% if you were educated on how loans actually work and what you could do about it. Oh my gosh. And not only that, but we have developed an AI system that reads bank amortization schedules and tells you exactly what to do and when to do it with your current budget. So it makes it impossible for banks to charge you all of that interest. Oh my goodness. You definitely want to see that. Here's another example. Okay. $1 million in debt, $1 million in debt, $1,033,000 in debt here, with 12 credit cards adding up to $201,000. Just the credit card debt is $201,000, averaging 10.95%, and two mortgages of $634,000. And the way that we help this particular client, instead of paying $692,000 in interest, they're only going to pay $179,000. That is $512,000 in interest savings, and an effective interest rate of 1.10%. That's what we should be paying right there. We should be doing that instead of what the bank wants us to do. All because of what I'm getting ready to show you, where all of this came from. Lofty, what are you doing in the audience? Okay, I see you there. Anybody else that needs to come to the stage needs to come to the stage.
Yeah, I invited him up. Man, he a long time no see for me.
Yeah,
But
Loft.
you got a couple people on chatter trying to come up. I didn't want to disturb you while you was talking.
Oh, they trying to come up. All right, let me do that. Thank you. Let me invite them to the stage here. All right, there we go. I just invited them up. Let me see if I can get them to come on up. All right, Angela, I see you. Good morning, Angela. How are you? Good morning, Angela. How are you doing?
How are you doing?
Uh-oh. Uh-oh, I've got an echo. Let me see if
I'm good. How are you?
excellent. Excellent. Let me see if I can. Let me see if I can fix that today. All right. Angela, can you hear me? All right. I can't hear you. Let me see how I can.
I had chatter in Clubhouse.
All
I
right.
closed out Clubhouse.
Oh, you closed out Clubhouse?
Yeah.
Okay, good. All right. And so I think I've got rid of that. I think I got rid of that echo. Excellent.
Yeah, the echo gone, Don.
Okay. So we got live on Chatter. We're okay. So we're on all of our social media should be up and running. I got Ken here. All right. All right. Now, if you guys want to see what's going on, go over to YouTube and Facebook. All right. So now let me bring up one more example and then we'll get into where all of this came from. Here's another example. We have 5 credit cards, $18,000, $390,000 in mortgage debt. Okay. $7,700 in other loans. All right. And we have $163,653, all right, in total interest payments that the bank wants on how much debt? $416,000. $416,000. The bank wants 163,000. And we have never been told how these loans actually work. But instead of 163,000, this particular client is going to pay $41,000 in interest instead. That is an effective interest rate of 0.64%, less than 1%. That is 75% off of what the bank wants, 75% interest reduction, meaning that saving $122,000 in interest that they were being overcharged. They don't need to pay. Let me ask you something, everybody. What if you found out that you are being overcharged by over $100,000 on your mortgage, student loans, credit cards, and car loans? What if you found that out? What if you knew that you could save $200,000 or more instead of giving it to the bank? So let me go into this thing. All right. So if you want to see this, this is from this is called the American Mortgage in Historical and International Context. I have it on my screen right now, and we're going to go down through this, and I've highlighted certain portions. Let me know in the chat if you want well, let me go ahead and put the link to this, as you may want to read this on your own. So I'm copying the link, I'm putting it in the chat so that you can actually have this if you want it. All right. And put this in the chat as well. Ken, if you see something in the chat I need to address, will you please let me know? Because let's see, I've got 1, 2, 3, 4, 5. I'm trying to watch 5 screens here. All right.
I got you, sir.
All right. So let me see here. That link did not go over to Facebook. Let me see if I can get it on Facebook. See if that works. Yeah, I think we got it over to Facebook this time. Okay, Facebook. All right, can get the link. Everybody's got the link. Now, here's what I need you to know. All right, highlighted here in this article, mortgage debt was 15% of household assets in in 1949. All right. And by 1979, 41% of all household assets. And okay. And this was it. We went from, in other words, we went from a nation of renters to a nation of home buyers. And the fact that these mortgages were introduced, these mortgages are credited to building up the middle class. Now people can own homes if they so choose by using these mortgages. All right. And so, and here is a graph of where we went from around 10% up to over 60%, how mortgage debt was a part of the, the American GDP. Okay. Now, here is some historical context. Before the Great Depression, the single family home was a very different instrument. Now, the loan terms were typically between 5 and 10 years. 5 and 10 years. You needed to have about 50 to 80% down, okay, on your mortgage, plus most of them, if not all of them, were interest only loans. They weren't amortized like they are today. There were no amortized loans before 1936. None. Zero. Okay. So now what was happening? Your loan term was between 5 and 10 years. Some of them were as short as 3 years. And then when your term ran out, okay, there was a big balloon payment at the end. Okay, because no money went to pay down the loan. You were only paying interest. So after your term ran out, you were expected to renew the loan. All right. So to get a new term. And this is how loans were done. Now, if you happen to make enough money, you could pay the loan off if you wanted to, but a lot of people didn't. They just kept paying. They just kept paying the minimum payment, which was just the interest on the loan. A lot of people did not pay money towards principal. Okay. So, but during the Great Depression of the 1930s, property values in the United States declined by 50%. So when the stock market crashed and everything started to go to hell in a handbasket, here is why most people lost their properties. Not because they couldn't make the payments. It was because once their term ran out, the banks would not reissue the loan. They said, "Oh, this loan has come due now. All right. If you can't make the balloon payment, we're not going to give you an extension on this anymore. Make the balloon payment or lose your property." That's what was happening. Okay. Over 250,000 a year, these loans were in default. It was crazy. And the more that the loans defaulted, okay, the more people that defaulted, the property values sunk even faster. And so there was no way you could sell the property. There was no way you could leverage the property. All kinds of things were going on. Okay. So if y'all want to ask questions, feel free, come to the stage, stop at any time. Jonathan Bing, how are you doing this morning, sir? Okay. So we are live on Chatter this morning. And if you want to ask a question on Chatter, just open up your mic and ask. Okay. All right. So listen, what do we got here? What do we got here? Okay. Now, in response to these calamities, the federal government began intervening in the housing finance market. It created 3 particularly important institutions. Here we go. The Homeowners Loan Corporation, HOLC, the Federal Housing Administration, FHA, and the Federal National Mortgage Association, FNMA, which became Fannie Mae. Okay. So the Homeowners Loan Association raised funds using government-backed loans. Okay. And they use these funds to purchase the defaulted mortgages, all right, and from financial institutions. Then the HOLC changed the terms of the mortgages drastically, converting, all right, converting variable rate short-term non-amortizing mortgages. These were the interest-only mortgages at the time, into fixed rate, long-term, 20-year, fully amortizing mortgages. And what they were telling the public is when you get this mortgage, you're constantly paying on the principal, and in 20 years, there would be no balloon payment. You would be done. That's what they told them, right? And this thing was a novelty in 1936. No one had ever had that kind of loan before 1936. All right. So an amortizing mortgage is one where the principal is repaid over the life of the loan, so the borrower does not have to face a large lump sum or a balloon payment at the end. Okay. So the HOLC ultimately purchased, reinstated, and converted 1 million mortgages. Now, here is the good part. Here is the part we don't get to hear. Here's the part we've never heard before. Because the federal government did not see itself as being in the business of holding mortgages in the long term, it needed a way to make these mortgages marketable. I need you to focus in on this part, ladies and gentlemen. These mortgages needed to be marketable. In particular, investors in mortgages wanted assurance that they would receive the full payment principal balance and scheduled interest payments. Stop right there. Let's break this part down. The government did not want to be in the mortgage business. So what they did was created a secondary market so that these mortgages could be sold to investors. All right. And the investors wanted to be assured of two things. That they would receive the full principal balance, they would get paid back, and the scheduled interest payments, meaning there's a 20-year schedule that they would receive interest payments, and that's what they wanted. So in bringing the country out of the Depression, these mortgages were issued, but they were sold to investors. So the mortgages had to be marketable. How many of you have a mortgage right now? How many of you have gotten a mortgage? And because of that, because you have a mortgage, oh my gosh, it was sold within a week or two after closing. Huh? How many of you got a mortgage? All right. If you have a mortgage right now, all right, and it was sold like a week or two after you closed, put a 7 in the chat. Put a 7 in the chat right now if your mortgage has ever been sold, because this is how the game is played, ladies and gentlemen. These mortgages have to be attractive to investors. Now, I want you to listen to me, and listen to me well. Most banking institutions do not make a dime of profit from the interest on your loans. They don't. Now, I know I do. I'll use shortcuts all the time and say the bank is charging you all this interest, but in reality, the bank is not. The bank is not. The bank sets it all up. Your mortgage company sets it up. But these loans are ultimately sold on a secondary market, and investors purchase them, and they're called mortgage-backed securities, MBS, mortgage-backed securities. I need you all to write this down, because without this system, our particular the way mortgages are done in the United States would have to be done another way, or the system would collapse. There's so many mortgages out there. Banking institutions cannot lend out that much money and stay solvent. It would just be too risky. So they package these mortgages up in mortgage-backed securities, all right? And they're different grades, and then they sell them on the open market. Now, what happened back prior to 2008, that some of these mortgages, because they were substandard, okay, they weren't A paper, okay, they were being sold as top-notch paper. In other words, they were sold as mortgages that were good to go. All right, they were A plus borrowers, and because there were so many substandard loans in there, okay, that when these loans started to default, the mortgage-backed securities, the value of them plummeted, and this whole thing uh, took us into a not a depression, but a great recession. Okay, because the whole business started to crumble. If these mortgages are not attractive to investors, they won't purchase them. And if investors don't purchase them, the banks will not issue mortgages, because that's where they make their money, is when your mortgage is sold. They sell it at a premium. And now the people who own the mortgages now are looking for two things. They're looking to get paid back, and they're looking to get their scheduled interest payments. All right. So let's go ahead and read a little bit more. Let me see here. While some private mortgage insurance companies were in business for the purpose, okay, I skipped something. In particular, investors in mortgages wanted assurance that they would receive full principal balance and the scheduled interest payments. While some private mortgage insurance companies were in business for this purpose before the 1930s, they were insufficiently capitalized and failed in the early 1930s. Consequently, the government established the Federal Housing Administration, FHA, to provide mortgage insurance necessary for investors to purchase mortgages with confidence. Okay, that's where PMA came in, private mortgage insurance, back then in 1936. All right, so the government got involved not only in mortgages, creating a secondary market to sell the mortgages, but also private mortgage insurance. All right, PMA. So this is what's going on in the country. It was touted as something for the consumer, when in fact, let me see if I can find this. This invention, I need you to listen to this now. This invention of the fixed rate self-amortizing long-term mortgage was above all else, oh my gosh, here it is, above all else, a response to a general financial crisis, as opposed to a design for the promotion of home ownership per se. It wasn't for us, it was for the banks, so that we can have an economy that could actually work and thrive. And because of this, homeowners, home buyers rather, more people were able to buy homes and keep the economy running. So listen to this part. FHA adopted this form of mortgage to avoid the problem of people needing to refinance, which had clearly led to disaster. Now, before they had to refinance. Now they don't have to. People choose to refinance now, but back then they had to refinance. The combination of HOLC and the FHA represented a piece of early financial engineering that allowed illiquid, that means financial institutions that were not liquid, all right, that allowed illiquid financial institutions to become liquid again. How did they become liquid? They issued the mortgages, and then investors paid them back within a week or two. And they got their money back. And that's how they made profit, because they would not sell the mortgage for what they got it for. They would sell it for more. And then the investors said, well, shoot, we're going to have these things for a long time. We'll be able to make our money back based on that. Okay. Based on the fact that these are 20-year mortgages. And here's the thing: if you don't know how much interest you could save by prepayment, then the investors are going to look at these mortgages as profitable and as something they desire, because you and I don't know how they work. We were never supposed to learn how they work, because the whole thing is based on investors buying the mortgages. Okay, the Homeowners Loan Corporation, having performed this task, was disbanded in 1936. Okay, they did their job. And in its place, the Federal National Mortgage Association came in, the FNMA, okay, which would later be Fannie Mae, was invented as a government agency in 1938 for the purpose of abetting a secondary market. Now, when I saw that, I said, I wanted to look up that word abetting. So what I did was I went to Google, all right, and I looked up, all right, I'm going to put it up here, and I'm going to Google it again, abetting, all right, the secondary market. Let me see, A-E-T, all right, I-N-G. And what is the definition of abetting? All right. Let me see. Here is the first. Here is the first definition: encourage or assist someone to do something wrong, in particular, to commit a crime or other offense. That's the very first definition of a bet. And I'm just saying that's just so ironic. All right. So that these things were happening, not for us, but these things were happening to us. Listen, I am so surprised I'm not getting any questions or comments on this right now. All right. Let me see what else is happening here. All right. So let's see. Uh, in, in particular, Fannie Mae issued bonds for purchasing mortgages at par, so that the investors in affluent communities could invest with confidence in mortgages in communities with little local capital. Buying at par meant banks had no exposure to interest rate risk when lending long term and funding these loans by Fannie Mae issued bonds. The mortgage market changed little in the 6 years following the invention of FNMA. The depression, the late 1930s and World War II were all times when were all times when the housing market was relatively little construction and few transactions. In 1925, though, new home constructions in the new home construction in the United States peaked at 937,000 new units. This total fell to 93,000 units. Okay, so there was a housing shortage. With the anticipation of the end of World War II came the GI Bill of Rights, officially known as the Servicemen's Readjustment Act of 1944. Included within the GI Bill was the invention of the Veterans Administration Mortgage, or the VA mortgage. And this was in 1944, folks. Now listen to this part. Okay. This program, a program which allowed veterans returning home to obtain mortgages with very low down payments, and in a lot of cases, no down payment. The mortgage was intended both to reward veterans and to stimulate the housing market construction, stimulate housing market construction. At about this time, the Federal Housing Administration also sought to stimulate housing construction by substantially liberalizing loan terms. In 1948, the maximum term of a mortgage rose to 30 years. So the 30-year mortgage came into being in 1948. 1936 was the 20-year mortgage. 1948 was the 30-year mortgage. In 1956, the FHA raised the minimum loan to value ratio to 95%, meaning you could get 95% loan to value. You can get a loan. You had to come up with 5%. And from an initial maximum of 80%, where you had to have 20% down for the new construction and to 90% for existing homes. However, the FHA did not retain a cap on the size of the loan. It would ensure, and in doing so, it allowed for a private sector market in mortgage insurance to develop for high balance loans. So now we have insurance, we have mortgages, we have in 1948, we have now the VA loan. Now I'm laying out for you a whole history here. And in none of this history, where it said that the general public was sat down and taught how amortized loans actually worked. They were not taught this. Okay? So, with the strong expansion of the US economy in the post-World War II period, driving up incomes, together with the new institution of long-term and therefore affordable fixed-rate self-amortizing mortgage, home ownership expanded rapidly. America was transformed from a nation of urban renters, okay, to home owners or home buyers, I like to put it, because you don't own it until it's paid for, all right? You're just buying it for the next 30 years. Now, here's what's happening. There was a boom in housing, all right? So to let's see, households rose from 43.6% in 1940 to last year's census, to last year's before World War II, to 64% by 1980. 43% homeowners to 64% homeowners by 1980. The FHA mortgage was key to this transformation. Its profitability in the U.S. To the U.S. Treasury induced large-scale entry of the private sector, which developed the self-amortizing privately insured mortgage. So this thing was profitable. This thing was seen as good for the country. We went from a nation of renters to a nation of home buyers. This article goes on to read that this helped to create the middle class. So now we have all these homeowners, we have all these home buyers, and we're using these loans, but we are not taught how the loans actually work. Can I tell you why these loans, we're not taught how they work? Put a number 9 in the chat. Okay, now we're going to get into, read the rest of the article yourself. I just wanted to give you a small history, what's going on here. Read the rest of the article yourself, and you'll be able to see this, because there are very few places where this thing is actually explained in detail. Here is what is not explained: how to read an amortization schedule, how you can understand for yourself how all of this works. So let's go into, okay, let me fix this for a second here. All right, we're going to fix this. Now we're going to go into, we're going to take a quick break. All right, take a quick break, and then when we come back from the break, you will then get to see what we weren't ever supposed to see about these loans. You see, they're designed to make a lot of money, but there's an inherent weakness in the system the banks use to make a lot of money. And if you ever found that out, you could actually borrow money in a way using the current conditions. Using the current conditions, you can actually use the same system to make it impossible for the bank to charge you interest. Let's hear from E.T. the hip hop preacher, who actually paid off his mortgage using the P.I.L.L. method.
Listen to me, y'all. But one of his mentees took us through one of their programs, and I paid off my mortgage. But guess what happened? My marriage went to a whole nother level. And you know why? Because my wife is a security freak. And even when I blew up, my wife would be like, "Oh, you blew up, but how long is you gonna keep making this kind of money?" I was like, "I don't know, forever." She's like, "You sure?" Because I'm gonna keep my license as a nurse just in case you don't. So when I paid the house off, my boy was like, "You ain't gotta do that, you can do this." But when I paid the house off using that program, it took the stress level all the way down from my wife because we no longer had a mortgage. Does that make sense? That thing that was coming every month, that was getting on her nerves, we didn't have that no more. And so she was at rest.
All right, folks, we're back. All right, so now I'm going to put this on the screen. If you want to see this, go to the link that we put in the chat earlier. Go to this link. So let me go ahead and copy the link and put it back into the chat. All right, so you don't have to look for it. Okay, here we go. There it is. You want to see these numbers. Okay. Let me tell you something here, because this is very, very, very important. Without this system in place, we wouldn't be able to get fixed rate mortgages today. Most countries, most first world countries that have a similar standard of living as the US require that people refinance their loans every 5 years, like Canada, okay? Because they have variable rate mortgages. And because they have variable rate mortgages, then they are required to refinance every 5 years. So this system in place actually is responsible for us being able to, most of us, to get a fixed rate mortgage. And in Canada, on mortgages, there are a lot of prepayment penalties, which we can get into a little bit more. Okay, so I want you to see what is going on with this loan when you understand how the whole thing works. So we're going to put this on the screen. I have a 200,000. The median home price on mortgage now is 400,000. So that's where we're going to go. Let's do that. Okay. 400,000 at 7%, ladies and gentlemen. Here's the payment is $2,661.21. Okay, that is the payment amount. So let me change this over to here. All right, there we go. All right, $2,661.21. Now I need you to see on a $400,000 loan, the amount of interest is $558,035.60. First of all, let's break down how 7%, a 7% loan, okay, gets to be $558,000 in interest saved, in interest paid. $558,000 on a $400,000 loan, which means The bank wants you to pay back $958,000 for a house worth $400,000 in a $400,000 neighborhood. Does anybody want to pay twice for your house? Do you want to pay twice for your house? There's something going on with this. And I'm trying to tell you here, this can be used to your benefit. And all we have to do is start teaching how loans actually work. Ken says, no, he doesn't. You can actually learn how this works so that you don't have to pay all of that interest and you can start learning it in junior high. I teach this to middle schoolers and they get it. In fact, they don't understand why their parents are paying so much interest when you don't have to. Let me show you how this works. So first of all, we're going to put a calculator on the screen and break down how this works. So it's a 7% loan, all right? So we take 0.07, which is, that's the 7% as a decimal, all right? And then we divide that by 12. Once we divide that by 12, here's the number that the bank uses each month, 0.0058 and a bunch of threes. They take this number and multiply it by the unpaid balance each month. And in fact, and we're starting out with $400,000. So if we take $400,000 and multiply it by 1/12 of the interest rate times 400,000, okay, equals $2,333.33. Let's take a look at the very first interest payment here. $2,333.33. This is why real estate investors love these loans, because out of your payment of let's see here, of 2,000, your total payment is $2,661.21. Out of that $2,661, your payment is discounted by $2,333.33. What percentage is that? Why do investors love to invest in mortgage-backed securities? Here is why. Because when you pay them, you pay the entire payment. The entire payment goes to the investor. So if you were, let's say if you were, you sold your house and you were owner financing it, okay? And your interest rate was 7% on a 30-year fixed, okay? When that payment is made, $233 is credited to interest, while only $327.88 is applied to principal. So let's take a look at the interest payment, okay, which is $2,333.33. Let's take a look at the interest payment, and now we're going to divide it by the principal payment, the whole mortgage payment, which is, so we're going to divide it by 2,661.21 equals 88%. 0.876 is, so because the third number here is a 5 or more, we round up this number to the next number. So it's not 87, but 88. 88% of the payment is discounted, and therefore only 12% goes to pay down the mortgage. Do you see why people who invest in mortgage-backed securities are saying, yeah, it says 7, but when you guys pay me, I get to keep 88%. Only 12% of your payment actually brings down the loan, so that you have to pay so many more times to pay back the $400,000 that you owe, because you're not paying it at $2,600 a month. You're only paying the loan back at $327 a month, and the next month is $329.79. The next month is $331.71. The next month after that is $333.65. So $300 payments out of the $26.61 that the investor receives, only $300 is going towards paying back the loan. I need you to think about this for a minute. What if you had a swimming pool? Okay. And instead of a big hose like from a fire hydrant to fill up the pool, what if you're trying to fill up your swimming pool with a bucket? And when you fill the bucket up with water, by the time you got the bucket over to the pool, 88% of the water leaked out and only 12% of the water was going into the pool. How many more trips would you have to make if 88% of the water leaked out? How many more payments do you have to make when 88% of your payment is discounted? This is why real estate people who invest in mortgage-backed securities love to invest here. They absolutely love it. And because we don't know how an amortization schedule actually works, we have not been taught how an amortization schedule actually works, that we continue to do this because everybody is doing it. Nobody is questioning it. Nobody questions what is going on here. And they assume that the interest that the bank is asking for, we have to pay. So I'm telling you right now, the interest that the bank is asking for is just a suggestion. You don't have to make 360 payments. You can make fewer payments if you learn the benefit of prepayment. Now, here's what I need to show you next, okay? I'm going to pull this up, all right? I'm going to put in Google mortgage-backed securities, all right? And managing prepayment risk. When I studied mortgage-backed securities, there were two things that investors are afraid of. One is if they were going to get their money back, whether the borrowers will default. But do you know the number one thing that they're most afraid of? If you do this search on your own, mortgage-backed securities and managing prepayment risk, they're most afraid of prepayment. And there are thousands, I mean thousands. Look at this: prepayment risk, definition, consequences, examples. There's a ton of math that goes into trying to manage prepayment risk on these loans. Here's another one: mitigating the risk of prepayments. So if you're going to be investing in mortgage-backed securities, you want to have some idea of how many of these loans are going to get prepaid so that you will not receive all of the interest you are looking for as an investor in mortgage-backed securities. So it is very important, listen to me, it is very important that you never know how this works. Because if you did, investing in mortgage-backed securities would not be as attractive as it is today. Let me show you why. Because of what's happening here, and I'm going to do a couple of examples to show you what I mean. Okay, we're going to understand the benefit of prepayment. Now, I'm not telling you this is how you should do it. I'm just using these simple numbers because it's easy to see. In this very first payment of $26.61, okay, $327.88 is applied to principal. I mean, that's applied to your balance to bring it down. Only $327 out of that money, which brings you down to $399,672.12. Now, remember, I told you that each month, that number is used to create how much interest you owe on the very next line. So now we're using this number, the 399, and we bring up our calculator again, We take 0.07 divided by 12. We take this number, and now we're going to multiply it by the new principal balance of 399. Okay, 399,672.12. So we're going to multiply 399,672 and 12 cents. Our next interest payment is 2331.42, and that's exactly what we see here. 2,331.42, which is discounted from your total payment of 2661.21, which means a little bit more money, about $2 more goes to principal this time, because each month the payment never changes. The amount of the payment never changes. Okay. But the configuration changes each month. A little more goes to principal, a little less goes to interest each time, because you're bringing down the mortgage balance by $327, $329, $330 each month. When you do that, now they have to do a new calculation. So, folks, it's not one mortgage times 7%. It's not $400,000 times 7%. It's 1/12 of the interest rate multiplied by the unpaid balance 360 times. So it's not one mortgage. You get a brand new mortgage every single month. It's 360 of them. That's why it's so doggone expensive. Let me show you here when you look at cumulative principal and cumulative interest. When you get an amortization schedule from the bank, you will not get these two columns. A column that helps you to add up the principal that you're paying towards the loan and the amount of interest that's discounted from your payment every single month. So in the first year, I need you to see 12 months worth of payments here. Out of the money that you pay the bank, look here, $4,063.23 is applied to the loan. That's 12 principal payments, okay? Comes to $4,063.23. Your payments are discounted by all of these interest payments, 12 months of that. And that comes to $27,871.29. In other words, to pay your loan down by $4,000, the investor discounts your payments by $27,871.29, which means you got to keep paying so that more money continues to go to principal, because your payment just got discounted by over 80%. This is why it's so attractive to them right now. Okay. Any comments? Any questions about any of this? Any comments? Any questions? Okay. So let's move on. Let me see here. Amortization. All right. Stan Ellis was there for a hot minute, but I think he left. All right. And he put in the word amortization. All right. So what we're looking for, ladies and gentlemen, is what we can do about it. Okay. I got some comments here online. All right. Ricky D wants to know, is this recorded and is it available later? Yes, it is. So we got his question here. Is it available later? Yes, it's all, whenever we do a show on YouTube or Facebook, it is always recorded. Okay. All right. So it's even recorded on Chatter. Okay. So people can watch it later. All right. So Ricky D says, perfect. Thank you. All right, Ricky D. Thank you for being here today. Okay. So now here is what you also need to know. All of this, like I said, is in place for real estate investors. And this is the part you're not supposed to know. And I'm going to show you in two different ways. Here's the first way. If we're making this first payment in January, the February principal payment is $329.79. If you're new to the room, go to the link in the chat and watch this on YouTube, or you can go to Facebook and search for P.I.L.L method, and you can see it there. Okay. $329.79 is next month's principal payment. But if you wanted to, and if you had it, you can prepay, meaning give money to the bank before it's due, exactly $329.79. If you did that, here's what would happen. This money is applied to principal, all of it, $329.79. All of it is applied to principal, and you're brought down to $399,342.33. All of it is applied to principal. So when the bank's computer sees this number, the 399,342.33 in January, it says, I have to take 1/12 of the interest rate and multiply it by this number instead of the first number, 399,672.12. So when we use this number instead, here is what happens. So we're going to take our 7% interest rate again, divide it by 12 equals this. So now we're going to multiply it by the 399,342 instead of the number on line 1. So multiply it by 399,342.33 instead. And that equals 2329.40.496, which means we round this up to 50 cents. 2329.50. Let's take a look. Look here. We have to drop down to line 3. If we prepay this amount on line 2, we have to drop down to line 3. And this is our new February payment. We just got rid of line 2. Listen, this is why real estate investors are so afraid of prepayment, that you will find out what's going on here. Because for only $329.79, taking out of, let's say you had it in your bank account, your savings account maybe, making 1/10 of 1%, you take that money and apply it to this mortgage, it saves you $2,331.42 in interest you never have to pay. Wow. Now, here is what most people believe. Yes, we will save that money, but that is after 30 years. No, it's not. Listen, if it's something that you can pay next month, something that you have to pay next month, and you don't pay it next month, then it's something that you save now, not 30 years from now. Okay? So your whole interest payments that the bank wants you to pay has just been reduced by $2,331.42. Okay? So let me show you what would happen if you made the payment in January and you gave the bank a little over $1,000. That would be the principal payment on line 2, 3, and 4. That's 329, 331, and 333.65. You give that to the bank, a little over $1,000. Look how much it saves you in interest, over $7,000 in interest you never have to pay. You give them 3 principal payments on top of that, a little over $1,000, and look what happens. You're now on line 5 of this amortization schedule. You just cut out 3 payments that you never have to make for $1,000, not the money that the bank was looking for. Do you see how powerful this is? Do you see why people who invest in mortgage-backed securities are more afraid of prepayment than they are of default? This is why you are not taught this in middle school. And for those of you who don't believe this, let me show you when you figure this thing out. Let me show you what would happen here. Let's take a look at 1 year. Okay, all the principal payments added up come to $4,063.23. Let me ask you. All right, Ricky D wants to know, How do you send the additional principal? Oh, Ricky, they make it real easy now. You can go to your website. This is a question he's asking. Let me put that on the screen. He's asking, how do we send that in additional principal? You can go to the website, whoever your lending institution is now, whoever holds the paper. Okay, you can go there and make your payment for your mortgage payment, and there should be a line there that says additional principal payments or something like that. And you can put any amount on there. You can put $1 on there. You can put $5. You can put $100. You can put $1,000. You can put $20,000 in prepayments on that line if you want to, if you had it. So whatever you want to prepay, you put on that line and just click send. And then you are now sending money from your bank account to mortgage principal electronically. They make it so easy. What they're not telling you is what's important. Not that you can prepay, but what do you get when you prepay? Because no bank I know of has ever said, thank you for your prepayment. We've received it and we've applied it to your principal. Okay, they've done that, but they don't tell you how much interest you just saved. Oh my goodness. Let's take a look. Can we take a look at 1 year on this thing? So if I did 1 year on this thing, paid down the loan by $4,000 and given the bank $27,871.29 in interest, everybody's happy because I paid on time. But let me ask you, if I already know that I got to pay this loan down by $4,063.23, do I have to give it to the bank in 12 monthly installments? Because if I do it their way, to get this $4,000 in equity means the difference between what the house is worth and what I owe. Okay. And if things are going right, I've just created $4,000 worth of equity because I paid the loan down. But it costs $27,871.29 to do it their way. So let's see what would happen if I had the same loan, okay, and then ask this question. Do I have to pay this $4,000 down in 12 monthly installments, or can I give it to the bank all at once? We're going to do just a little bit more math here to show what would happen if I had a $400,000 loan and I gave the bank $4,063.23 up front, okay, minus $4,063.23 equals $395,936.77 right here. $395,936.77. Do you mean if I give this to the bank in 1 month, at month one, I'm paid down to here in 1 month? And I don't have to pay $27,000 in interest, because this $27,000 in interest is added up over 12 months worth of payments, ladies and gentlemen. If I get here in 1 month, guess what? I get to pay only $23,33.33 in interest to pay my loan down to here, not $27,000. That is a $25,559.62 savings. Can anybody tell me whether they are a home buyer or a real estate investor? Is there any reason, if I have the money available, is there any reason to pay your loan down by $4,000 and give the bank $27,000 in interest when you don't have to? Is there any benefit to paying $27,000 in interest instead of $2,300 in interest? Is there any benefit to paying $27,871 in interest? Oh my goodness. This is what we're doing, ladies and gentlemen. And for those who are saying, Don, you don't save that much interest. You know what somebody had tried to tell me once? They said, Don, look at this. Do you see the difference in the interest here? You pay 23.33 in interest on line 1. Look at the interest payment on line 13, because that's where you would be if I gave this to the loan, all right, all at once, all right? I knock off these 12 payments, and now look at this. My next principal payment is 2309.63. You know what they try to tell me? Don, you're not saving over $20,000 in interest. Here's what you're saving. They took this number, 33.33, and subtracted the interest payment on line 13, 2309.63 minus 2309.63 equals $23.70. That's what they tried to tell me, that you're only saving $23.70. Does that make sense to you? This is when you make a payment, you're only saving 7%. No. You're not saving just 7%, and I can prove it. All right. If you want to see the proof, put a number 7 in the chat, and I will prove to you that you're not saving $23.70, that you're actually saving over $20,000 in interest you don't have to pay. So put a number 7 in the chat if you want to see the proof of that. Okay. Put a number 7 in the chat if you want to see the proof of that. If you don't want to see the proof, that's okay. I understand. Oh, Ed Zones wants to see the proof. Okay. Wants to see. Listen, I only need one. To show the proof. Here it is. All right. And I see it online as well. Ricky D wants to see the proof as well. Okay. Ricky D, you want to see it? You put a number 7 in the chat. All right. Let's see it. So I already did the math on this, where if we paid this loan down by $4,063.23, we're paid down to $395,936.77. We've already done that math. So let's take this loan. Okay, let's take this, copy it, and put it in a new amortization schedule. Okay, so we're going to take this and put it in here. Okay, and we're going to paste it in. Take the comma out. All right. And if any of you want to know, I use this as a Brett Whistle. B-R-E-T is his first name. Whistle is his last name. W-H-I-S-S-E-L. This is his amortization calculator online. I use this as a teaching tool. This is not my program. Okay. My program is different. So, so the payment stays the same. The interest rate stays the same, but we're going to take out the number of payments here. So if we only owe this after the first payment, here's what your new amortization schedule does. Anytime you prepay, you actually get a new amortization schedule from the bank. And here's what the new amortization schedule would be. Okay. Oh, there are only 348 payments left. If you give the bank this much money, $4,063.23 on line 1, you're paid down to line 12 here. Okay, $395,936.77. So now let's put that in the amortization schedule at 7%, and we have exactly 12 payments less. Exactly 12 payments less. And so when we do the math on this, how much interest do we owe now? Okay. Total interest paid is $530,164.31. So let's bring up the original amount of interest that the bank wanted. Hey, the original amount of interest that the bank wanted was $558,000. That's this number right here, $558,035.60. When we prepay, all right, this amount, $4,063.23, we're left with this. So we put that in a new amortization schedule, all right? And we're going to subtract now the new interest amount that we owe. If all we owe was $359,936.77. So we're going to subtract that. Okay. 395,936.77 equals exactly, let me see here. Did I do that right? Okay, hold on. Okay, I did something wrong. Sorry. Let me do that again. All right, so we have, bring back my calculator. Sometimes I do it too fast for my own good. Okay, so we've got the interest amount here of 558, $35.60. And we're going to subtract the new total interest amount of 530. Okay. All right. Let me bring this back. Okay. All right. Minus 530,164.31 equals, there it is, $27,870.29 less. 27,870.29. If I go back to the original loan, bring back the calculator, I need you to see 27,870.29. Look here. 27,871.29. Look at that. Practically the same. Practically the same. Folks, here's what I need you to know. The way the mortgage system is set up is so that you don't understand how it works. And if you don't understand how it works, how could you possibly know how to save money in interest? Okay. So Ricky D online is asking a question. It says, would it make sense? Would it make sense to get a 60-year mortgage to allow for lower monthly payments so we're more comfortable paying extra payments each month? Okay, let's talk about that. Number one, that they're talking now, Ricky, about 40-year mortgages, making them part of what we're doing now. Okay, 40-year mortgages. I have not heard of 60-year mortgages. I'm not saying they don't exist. I just never heard of them, but I doubt if they do. But let me show you why, if I could get a 30-year mortgage, I always get a 30. I never get anything less. And if I could get a 40-year mortgage, I would definitely get a 40-year mortgage because I'm in more control of the loan. And I'll show you why. We're going to bring up several. Okay, let's get rid of this. I want to show you something here as to why I never get a 15-year mortgage. Never do it, never do it, never do it. Okay, so we get let's see here, duplicate this tab. All right, so we're going to put in, we have a 30-year mortgage right here. Okay, 30-year mortgage. The next one we're going to put in is a 25-year mortgage, which would be 300 payments. That's 60 payments less. So we're going to put in 300 payments instead. Okay, that's a 25-year mortgage. All right, and we recalculate that. Here's our new payment. It's 2,800. Now we're going to do a 20-year mortgage. Okay, if we do a 20-year mortgage, that's 240 payments. Okay, that's 240 months. Now here's our payment. And we're going to do one more. Okay, we're going to do a 15. We're going to do a 15-year mortgage. All right, so let's put this here for 15. That would be 180 payments. Okay, 180 payments. So we take that out. Okay, there we go. Here's our new payment. Okay, 180 payments. Our payment would be $3,595.31. Okay, That's one reason why I don't like 15-year mortgages, because the payment is so high. Even if you can afford it, I still don't want that. Okay. And I'll show you why. That's a 15-year payment. All right. And now we're looking at a 20-year payment. It's a little bit less, 3,101.20. Okay. The next one is is 360 payments. Okay. 360. Okay. So I have 20-year. Oh, I need a 25-year. Okay. Let me put a 25-year payment here. 300 payments. We'll do 300 payments here. Okay. There we go. 28, 2712. And then here's the original 30-year loan. I like the 30-year loan with a smaller payment. Okay. And here's why. Because of amortization, we should learn this in middle school. All right. 7th and 8th graders should be learning this. If your loan is amortized, whatever the interest rate is, whatever term you have, you want the longest term available, not the shortest term. Here's why. Because they take the principal balance and multiply it by 1/12 of the interest rate. The interest rate is the same on all of these. And if it's the same on all of these, I need you to take a look at the very first interest payment on the 30-year mortgage. It is 2333.33. The payment on the 25-year mortgage is more, but the interest payment is exactly the same, 2333.33. So I'm still discounted the same amount. All right, the same amount of interest. And now this is the 20-year mortgage. Now the payment is even higher, but the amount of interest is exactly the same, 2333.33. And here is the 40. I'm sorry. Here is the 15-year mortgage, which is 35.95.31, and the interest payment is still 2333.33. It's exactly the same. Can I show you something else? Because you're not taught about this, because there are things that you can do to get that the bank is telling you that you could save money, but it's actually making it harder for you to save money every time you do it. Okay. Now look at the amount of interest you pay on these loans. All right. Remember, this is the 15-year mortgage. Look at the amount of interest that you pay in the first year, 27,504. 27,504. That's how much interest you pay in the first year on that mortgage. That's the 15-year mortgage. On the 20-year mortgage is 27,698. Okay, 27,698, 27,504. Okay, and so that's the 15, the 20, the 25-year mortgage, 27,806, and on the 30-year mortgage, 27,871. Virtually the same amount of money goes to interest on all 4 of these mortgages. Why would I ever stress myself out trying to get a 15-year mortgage when I'm paying essentially the same amount of interest on all of them? Why don't I just take the small payment and work with that? And I need you, if you've been listening to me, I need you to write this down. Control the principal payment and you control the loan. This is what the industry doesn't want you to know, so that these loans will still look good to investors. Okay? Watch this. Look at my principal payment. This is what I attacked the loan with. Remember, I said 329.79 knocks off one payment. That's on a 30-year loan. Watch this. 396 is on the 25-year loan. It goes up. 772 on the 20-year loan. And on the 15-year mortgage, $1,269.34. If I wanted to make every single payment, I would probably get a 15-year loan if I wanted to make every single payment on time. Okay. But I don't. I want to be able to prepay and have that money work for me. If I want to look at this 15-year loan, if I make this first payment and the interest is the same, I have to prepay $1,269 to knock off one payment. On a 30-year loan, I only have to come up with $329.79. Which would you rather? Ladies and gentlemen, which would you rather? And Ricky, I'm going to use your example, okay? Since I don't know those numbers right off the top of my head, because you brought it up. If you could get a 60-year loan, okay, that would be 60, okay, times 12. Oops. 60 times 12 months, okay, that's 720 months. So we're going to take this, we're going to duplicate it, and we're going to put in 720 months instead, okay? 720 months. Okay, 720 months. We take that out. Look at our payment now, 720 months. It's $2,369.30, all right, on a $400,000 loan. Okay, look at this. Look at the principal payment now. $35. Ricky, let me ask you. The interest payment is virtually the same, where you're going to pay $27,900 if you do it the bank's way. But your principal payment on a 60-year loan, if you could get a 60-year loan, is only $35.97. Everybody who's watching this, okay, if somebody wants to come up to the stage, invite to speak, all right, we'll bring you up. And that is Tanzel. Says no thanks. Okay, never mind. All right. So, Ricky, does anybody see, if you're watching this on YouTube, does anybody see any benefit of having a principal payment of $35.97, $36.18? Somebody come to the stage and talk to me about this and tell me if they see any benefit in this. You see any benefit in that? Ricky says 100% he sees the benefit in it, because to get rid of line 2, I only have to come up with $36.18 if I could get a 60-year loan. Okay? Don't be afraid of longer terms. Always get the longest term available, not the shortest term. Anything that you do that the bank allows, you're going to end up paying more interest because you have less control. Control the principal payment and you control the loan. Interest payments you can skip, don't matter. How much would if I do it the bank's way, how much would I pay down in principal? $445.72 in principal payments for the first year. Ricky, if I wanted to, could I prepay the $445.72, knock out a whole year, and save about over $20,000 in interest, over $25,000 in interest? Could I do that just on a 60-year loan by prepaying $445.72? Would I knock all of that interest out and be paid down to line 12 in just 1 month? $445 would do that on a 60-year loan. Okay. Ricky says definitely. He says 100% over here. Okay. He says definitely right here. All right. Look at this. $923. Less than $1,000 prepaid on this loan knocks off 2 years and saves 55 grand. My goodness. $1,436 prepaid would knock off 3 years off this loan if it were a 60-year loan. This is why real estate investors for this to remain solvent, for our system to remain solvent, real estate investors must see that these mortgages are attractive to own because the people who have the mortgages don't understand how mortgages actually work. Lord, Ricky says, Ricky says here, he says, I'm going to convince them to give me a 16-year mortgage. Lord have mercy. Listen, folks, what we're trying to tell you is that you can have great control over these loans. You can have great control over these loans. Just keep watching. Go back and watch this video again and again and again. Would you do this for me? Would you share this video on YouTube to your friends? Would you share this on Facebook to your friends? And on our IG, we have shorter videos. Would you go to my Instagram and share the last video that you see there? Share that off to people so they can finally know the truth about loans. Now, let me tell you why a person in the mortgage business would want to teach their clients this. You would think that they don't want this. You would think Jonathan Bing would say, Don, stop giving away all the sauce. You're cutting into my profits. Jonathan Bing knows that if I get a loan from him, he gets paid a commission on the loan. He's not paid out of the interest payments. He's paid a commission on the loan. If I pay this loan off in 7 years and Jonathan Bing had something to do with teaching me this, I'll probably get another mortgage. And where would I go to get another mortgage? I go back to Jonathan Bing in about 7 years and get another one. What if I really saw the benefit of this and start putting renters in these properties I was buying and paying off? And now I'm going back and I'm getting cash out refi on some of these properties. And then I get enough cash out to get 2 or 3 or 4 loans. I'm going back to Jonathan Bing because he showed me not only how to save money and interest, but how to get equity at 4 to 5 times the regular rate. And I can cash out refi on these loans to get money out to reinvest into other properties 10 to 15 years sooner, because he's more concerned about how well his client does. And when you are concerned about your client, when you are concerned about serving others, you make more money. What did I just say? When you're concerned about other people more than you're concerned about yourself, you make more money. And why is that? Because people will sing your praises up and down and sideways because Jonathan Bing, Don Daniel, or whoever else is teaching benefits. They will tell others. I'm just telling you. I'm just saying. This is how we've been in business for 19 years. This is how we're telling people the truth about this. And why hasn't it caught on more? Because it's going against everything people have been taught. And in fact, it is so mind-blowing that some people have trouble wrapping their mind around it. It's called cognitive dissonance. Look it up. Cognitive dissonance. When you have believed in something for so long and somebody gives you credible evidence that something else may be true, now you have that conflict going on. Do I do the new thing and save money, or I do the old thing that everybody else is doing because we trust that? We don't trust the new thing yet because it's new. But there are enough people who are taking a chance, who study. This is why we do these free rooms. This is why this video is going to be up on YouTube and on Facebook, all right, forever, and on LinkedIn. This is why we put it out here. So somebody who says, you know what, I I want to know what's going on. Listen, it doesn't make sense to me when I'm reading my papers, when I actually read the documents that I'm signing to get this mortgage. It doesn't make sense to me to pay 139.5%. And everything that I'm learning about how these loans work, do I refinance or not? Do I get the lowest interest rate or not? Listen, folks, you don't want the lowest interest rate available. Stop buying down. You want the interest rate that's right for you. Stop buying down the loan. Stop buying points. Don't let builders buy down the points for you. Take that money, tell the builder, take that money, that $12,000 to $18,000, and help me with down payments or something. Help me with closing costs, but don't buy down the rate. If you can afford the payment, watch this. If you can afford the payment on this 7% loan, you can afford the payment. What if you had to do the closing costs and the down payment or whatever? But the builder says, instead of buying down the rate for you, all right, we'll take care of the closing costs or whatever. What if we could do that for you? Now the money that you had, you can do something else with it. If you had, let's say you had like $20,000 that you had to do the down payment, you had to do down payment and you had to do closing costs, but now you don't. Somebody else did that for you. You can get this loan, take your $20,000 that you had to pay down and apply it to principal. Let me show you what happens when you do that. Let's go down $20,000 on this loan here. $20,000 takes off 53 payments. That's almost 4.5 years off this loan and saving over almost $120,000 in interest you never have to pay by taking that money and instead of making a down payment with it, instead of using it for closing costs, have that builder that says, oh, we're attracting you to us because we're going to get you a low interest rate. Oh man, I don't need a low interest rate. I need a low interest cost. And I can manipulate the interest cost much better at 7% as opposed to the 5.5% you're giving me. Oh, they're trying to buy it down to 5.5. Watch this. Okay, 400,000 for 30 years, 360. Okay, at 5.5%. Okay, don't buy it down for me. Okay, because you buy it down, yeah, I get a lower payment, $22.71, as opposed to $26.61. All right, so that's almost $400. That's almost $400 less because I allowed the builder to buy it down to 5.5. But remember, here's my principal payment, $329.79. I can come up with one of those, prepay it, and knock off $2,300 in interest. If I allow the builder to buy it down to 5.5 for me, now look at it's $439 for $39.83 as opposed to $329. So if you're going to prepay this thing, what's easier to come up with? $329, all right, at 7%, or $439 at 5.5%. At 7%, if I prepay $4,000, I can knock off a whole year. At 5.5%, if I prepay it, yeah, I can only knock off, about nine months. Everything that we've been taught to do, everything that sounds good to do, ain't good to do when it comes to amortization. When it comes to amortization, you need instruction. They're not teaching it in schools. They're not teaching it in grade school. They're not teaching it in high school. They're not teaching it in college. They're not teaching it in grad school. They're not teaching it to mortgage professionals. They're not teaching it to brokers, real estate brokers. They're not teaching it to real estate agents. They're not teaching this to CPAs. They're not teaching it to financial planners. They're not teaching how an amortization schedule actually works. We're the only ones that are teaching it are right here at the P.I.L.L method, ladies and gentlemen. We're teaching it so that you can know why it is important that you don't know how this works, so that the people who purchase mortgages can continue to purchase mortgages, and the very thing that they're afraid of, you don't know the benefit of. That is prepayment. And now you know. Now you know. Okay, so Jonathan Bing, do you have something for the people? Because I'm getting ready to get out of here. Listen, we did this show on the history of this, and starting next week, ladies and gentlemen, this is season 4 of P.I.L.L Method Live, and next week we start to go over prepayment of principal, isolating the principal amount, leverage, and liquidity. We're going to spend one whole show on prepayment of principal, then one whole show on isolating the principal amount, leverage, and then the next show on leverage. The next 4 weeks, we're going to be spending time on the 4 pillars of P.I.L.L method, so that you can understand not only are we teaching you the truth about lending, we're going to introduce to you the only artificially intelligent program that is designed to help you pay less interest on your loans using your current budget. Yes, you don't have to sacrifice lifestyle. You don't need more money to get out of debt in 7 to 9 years. What you need is to pay less interest. And our AI system is going to guide you like financial GPS on how to save not hundreds of thousands, not hundreds of dollars, not thousands of dollars, not tens of thousands, but hundreds of thousands of dollars in interest you don't need to pay to acquire the same asset, to buy the same house, to buy the same church, to buy the same business. You don't need to pay all of that interest. And the money you don't pay on interest to acquire the same asset, take the interest savings and invest that into your family, into your business, into your church, into your community. What could we do if everybody wins? The bank wins and we win when we don't have to pay all of that interest now. So, since 1936, folks, we have not known this, but now we do. I see Jonathan Bing in here. I see Daphne in here. So, Jonathan, are you ready to go to take the folks to the next level of what you have to share today? Daphne, are you there? I think Jonathan's getting ready. I think he's plugging stuff in because I'm getting ready to go. I'm getting ready to go to work. I never spend more than 2 hours in here because I want people to know. I want people to know what is happening with their loans. So let me get back here. All right. And while he's getting ready, okay, while he's getting ready, I'm going to take this off the screen, take this off. While he's getting ready, we're going to change this around. Okay. Change this around. Okay. Use this one. All right. And I'm going to, let me see, let me put a banner at the bottom of the screen. Okay. So you can call the P.I.L.L method here. It's at the bottom of the screen, 256-886-1867. You can call the P.I.L.L method and get more information. If you want to know what to do here, let's say you want to pay off your mortgage, your student loans, your credit cards, and your car loans in 7 to 9 years, you can get a free savings report. Go to ice10k.com. Let me put it in the chat for you. ice10k.com. The number 10. Okay. ice10k.com. And we're going to do the same online here. ice10k.com. And get a free savings and a free savings and earnings report. ICE, the number 10, letter K.com. Okay. I stands for interest cancellation expert. And that's what we are here. We're interest cancellation experts here at the P.I.L.L method. All right. So I'm getting ready to shut it down on Chatter, and I'm getting ready to leave here on Clubhouse. So, folks, if you're ready, Jonathan, Daphne, if you're ready, I'm ready to cut out. And I don't know if you're going to take over or not. But anyway, let me check and see if there are any questions before I leave. Ken says a penny saved is a penny earned. You got that right. That could mean, Ken says, that could mean another investment with those type of savings. You're right about that. Okay, and I don't see any other questions here. All right. If you want to talk to me in person, okay, I'll tell you what I'll do today. If you call that number, 256-886-1867, because I don't have meetings right away, but I do have some paperwork I have to get done. If you call and tell the receptionist, whoever answers the phone, tell the receptionist that I'd like 5 minutes with Don. Okay, 5 minutes. You can do that today. Don't do it tomorrow. Don't do it any other day. If you're watching the replay, don't do it. Okay, but call and ask for 5 minutes today. Okay, and you can ask me some private questions about what's going on with the P.I.L.L method and your situation. All right. Some people don't like to put their stuff out there on Front Street, and I understand that. So give me a call, because normally to get on my calendar, it's $150 for a consultation. Let's try to move people towards what's the word? We want to move people towards a knowledge of what's really going on. We want to move people towards a benefit of learning how to leverage money more effectively. We want people to learn how to borrow money at a discount, and stop letting the fact that we have never been taught this run our lives and have these particular loans keep siphoning off our wealth. Because while we're trying to create generational wealth, it's much easier if you're not paying twice for your house. How about that? Take that money you would have paid and invest it. We're going to be doing some great things in this next year, ladies and gentlemen, some great things as we continue to serve here. But make sure you're back next week, because we're going to do the first letter in the P.I.L.L method. P is for prepayment of principal. We're going to break it all the way down, so you learn a lot more. And then we're going to also get you ready for our 5-day boot camp. Oh my gosh. So much more information in the 5-day boot camp. You want to be in the P.I.L.L method live 5-day boot camp that we are preparing for you right now. So we're going to be instructing you in the next for the next 4 shows, breaking down the benefits of the P.I.L.L method, and so that you can see the benefit of joining our 5-day boot camp. You're absolutely going to love it. All right, folks, I'm getting ready to get out of here. Jonathan, Daphne, you guys going to take over? All right. Well, I'm shutting things down on Chatter right now.
Yeah, I just want to say thanks again, Don, for everything. Jonathan's in charge this morning. I'm not sure what he's going to do, but I just wanted to say thank you to you.
All right. We just ended the room on Chatter. We're going to be cutting it off here online as well. I'm going to say goodbye to everybody. So we're going to play our theme music. We're heading out. Okay. So thank you, everybody, for being here with me today. I appreciate sharing with you, and I get energized when I share this information. So let me go here and get ready. Okay, here we go. Here's our outro. I want to say goodbye, everybody. Don's cutting out. We'll see you.